Welcome to Leizer Property Management, your local expert in U.S. real estate investing. In this video, we'll go over the price ranges of our typical investment properties and lay out the various costs involved in homeownership. For those that have considered investing in U.S. real estate, the return on investment, also known as the ROI, may be the most important factor to consider. In this video, we'll break down the numbers in order to properly set your ROI expectations, with a focus on Cape Coral, Florida, and Tucson, Arizona, our two primary markets of expertise. First, let's discuss pricing. As you can imagine, Florida and Arizona real estate prices have a very wide range, anywhere from below $150,000 for old, beaten-up properties in poorer neighborhoods, to multi-million-dollar custom-built mansions in exclusive and prestigious communities. Through nearly a decade of experience and experimenting with different types and caliber of properties, we found our niche in the roughly $350,000 to $400,000 range. I'll explain why this price range is ideal for us by discussing why we avoid homes outside of this price range. So why not less than $350,000 USD? Firstly, cheaper properties tend to also be smaller and often do not fit an average family's needs. Cheaper homes also tend to be older, in poorer neighborhoods, and in relatively bad condition, and in need of serious repairs or renovations. All this means a few things. 1. These properties tend to attract lower caliber tenants that will likely have payment issues and will not treat your property with care. 2. These properties are not likely to meaningfully appreciate in value over time. While returns may look great on paper, the reality for these types of investments is typically a much more negative story. Then why do we stay away from more premium homes that cost over $400,000? The reason for this is simple. Firstly, when you have more expensive homes, you expect rents to naturally be higher, and not a lot of renters can afford rents on premium homes. And oftentimes, those that can afford to pay higher rent are typically in a position where they'll either rent for a very brief period of time, more of what we would call a transitional tenant, or they'll simply purchase something themselves and would rather be homeowners. As a result, we tend to see a much smaller pool of renters for more premium homes, which ultimately leads to longer vacancies and lower returns. For these reasons, we try to stay within our $350,000 to $400,000 range, which allows us to obtain good quality properties in solid areas and in good condition. That will attract a large pool of high-caliber tenants and will also appreciate nicely in value over time. So now that we've discussed pricing, let's turn our attention to returns. Here we have an example of a Cape Coral home with a market value of $365,000 and a market rent of $2,300 per month. In this example, we'll break down the operating expenses to an approximately monthly figure, even if they're incurred annually. Property taxes of $275 per month. Management fees, which are typically 10% of the monthly rental income, so here they're $230 per month. Legal liability insurance. This is optional, but we've included it anyway in the amount of $60. Flood insurance is also optional, but once again, we've included a $60 figure here. Maintenance costs. These are quite variable month to month, so we have chosen our long-term average of 6.5% of rents, which comes to approximately $150. When you subtract the operating expenses from the gross monthly rent of $2,300, this gives you a monthly net operating income of $1,525. To put this in perspective, this is an equivalent to an annual return of 5% on rental income alone, which does not include any appreciation in property value, which could also be very substantial. It is equally important to note that your rental returns are also likely to increase over the long term as we adjust rents to new market levels. In the lower half of the table, we also take into consideration loan interest payments from a loan or a mortgage, but this figure will vary greatly by investor. In our example, the home equity loan interest payment is $925 per month. When you deduct that from the net operating income, you get a monthly cash flow, which in this case is $600 per month. Thank you for watching this video. If you have any further questions, please don't hesitate to reach out to us.